Hey there, this is David Cox, Senior Portfolio Manager at Financially in Sync at Raymond James in Waterloo, Ontario, Canada. Today on the webinar, Where Do We Investors Stand? It is Thursday, July the 24th, 2025. I've been off a little bit here for holidays. I'm going to be off a little bit more, and so I thought I would get this webinar out today to give you something to look at here. Sort off by week on the intermarket analysis, you see silver up at the top here. Bottom line, risk assets have been rising, but the only thing that has not been rising and continues to fall has been crude oil. Again, I guess you could argue US dollar index, but bottom line, just a reminder, lots of content here. Pause your video player at any time for more detail. I found this interesting. This is the first time in over 30 years that Canada now has a falling price on a real estate basis on a 3-year basis. So we've got falling real estate prices over the last 3 years. Haven't seen that happen since the early 90s. I think that is no doubt a factor related to interest rates that have been rising over the course of the last 5 years and have remained, I mean, arguably stubbornly high. Now, I honestly don't think they're high. I think you already know that. But again, the media, certainly the borrowers, all the mortgages that got doled out in the last kind of 3, 4, 5 years, they're all going to be renewing. They are all renewing at much higher rates, which has an impact, which of course should affect the ability to not only afford that real estate, but create some supply as investors. And certainly some of the banks end up having to take over some of these properties and again, sell them. Let's stop to, again, just look at data, right? And so here's gold, Bitcoin, Canadian stocks, US stocks, Canadian dollars. And there's a lot of data here. So I'm going to speak quickly, and then I want you to just pause and just reflect on some of this data. I've sorted by year-to-date price change. So we've got gold up at the top, 28.7%, Bitcoin below it. TSX, the Toronto stock market has had a stronger so far year than the US market, but perhaps more importantly, the US market, which has been stronger for sure over the course of the past many years. In fact, going back about 15 years. If you take a look here, the Canadian dollar is actually up 5.7% this year. So that's important because that offsets the returns that are available as Canadians to foreign investment markets, right? So when we look out now, this is what happens. Trends start to change. You can see that even on a 2-year basis here, the Toronto stock market is playing some catch up. But again, lots of data here. And again, I just always like us to kind of think. I like us to reflect and whatnot. Here's the S&P 500. We're back in the bottom panel, over 60% of stocks above the 200-day moving average. That is good. That is a sign of definitely recovery and further evidence, I guess, of recovery. We're at 63%, and you can see there the 50-day stocks. We're talking 75% of the S&P is over the 50-day moving average. Again, we throw out lots of things in headlines. We're told lots of things by the media. This is the the sector returns rather, the 11 sector returns in the U.S. since the November 5th election of Donald Trump. Of course, huge fanfare and huge kind of criticism and huge media headlines. And bottom line is all this tariff, global, all kinds of business. But what's really been happening in the markets? Technology, industrials, communication, discretionary, and financials all have done the best. Now, what does that mean? We're talking the economically sensitive sectors, the offensively oriented sectors have done the best. And that is actually very positive. That says the market likes what it sees. If we look over on the bottom left here, we can see healthcare and energy and real estate and consumer staples have all done poorly. And those are the risk off type sectors, right? Those do well when risk is coming off. So this market continues to operate very, very positively, constructively, and again, continues to be evidence of the big picture uptrend that continues to be in place. Here's the Toronto stock market on the left. I've shown this before. On the right side here, again, back in 2014, you could sell a unit of the Toronto stock market for 11 ounces of gold. Today, you only get 5.9 ounces of gold. I'm not suggesting in any way that this makes sense, that a person would sell their stock portfolio to, turn it into gold. But again, I'm just trying to get us thinking, right? Challenge our thinking, challenge our, again, biases that we all have as investors. Chinese EV stocks on the radar this week. I was really interested, as you can see from my tweet here that I just posted in here. I saw a Lucid car on the streets the other day. So Canada has put a 100% tariff on Chinese EV cars that were coming into this country. Absolutely huge. And again, we're under review here at the WTO for unfair trade practices, but that was put in October of 2024. But the bottom line is these Chinese EV stocks that trade in New York, they've been absolutely obliterated and crushed, right? You can see on the left side, there's Lucid turning up on a bullish engulfing monthly pattern. And the same thing with NIO. XPeng is happening a little bit more constructively given it's got a higher low in place. But the bottom line is that, again, these are stocks, these are sectors, they go through ups and downs. And whether, governments push for electric cars or they don't, these stocks will do what they do based on demand and supply. But again, Lucid 97% down. Again, I just thought worth mentioning. Crude oil, I was on CNBC Arabia yesterday and had been asked to speak about crude oil. Again, crude oil is about the worst asset that pretty much exists. If you take a look at it on the left side, the weekly chart of crude oil, that's a lower highs, lower lows pattern. Again, having gone from free, which again, crude oil was free, and in fact, they gave you a bucket of cash in 2020 up to $130. We're now sitting around $65. On the right side, you can see here's two energy stocks that come from the InSync universe. Both are actually pretty weak. Cheniere on the top is not going up. It's started to kind of break down here in the last couple of weeks, but the bottom line is that, you know, Texas Pacific, look at that. That's a huge company in the bottom, had been a real massive leader into the fall last year. That's now down 47%, just wild. Let's continue to remember to zoom out, right? These home builders have come back to life here in a significant way recently, and I think that's very, very important to us. So this is D.R. Horton, DHI in the US. This is shown three different ways. It's the same chart. I mean, it's just essentially some of it is more zoomed in than others. On the left side, we can see the monthly chart over the course of the last 12 years going upwards. We can see the weekly chart in the middle over the course of the last 6-7 years, clearly going upwards, higher highs, higher lows. And on the right side, we can see that a lot of damage took place in some of these stocks, definitely made a lower low, but they are starting to move up again. And so this is where I think it's really important. We can get so focused, right, on that right side chart of the day-to-day and maybe the headlines that are coming out. But the bottom line is this is a chart that's in a long-term uptrend. So I think it's something we need to certainly be aware of. Here's a few things going on in AltSync right now. Interactive Brokers, very strong stock. You can see making highs this week. These are weekly charts. Excuse me, higher highs, higher lows is good. Netflix, I think it's come a little too far, too fast here. It's going to actually, it's set up so far, and again, the week is unfinished, but it's bearishly engulfed rather. Again, took some money off the table here in Netflix and put it into Lennar. Lennar is a peer actually of DHI, which is D.R. Horton, another one of those home builders. You can see also in a big picture uptrend. Let's also look at a couple more stocks. Fairfax Financial, just look, we want to compare these stocks. Why do we want to compare them? They're all from different areas, but here's three Toronto stocks, Fairfax on the left, Constellation Software in the middle, and Intact on the right. You can see Fairfax sitting closest to its highs. If you can see, these are all stocks close to their highs. But again, look at the underneath. These are actually versus the Toronto stock market. You can see Constellation Software giving up a little bit of ground. And again, I'm just trying to point this out because in a perfect world, what we want from our stocks is we want stocks that go up, absolutely, but we also want stocks that go up relatively. And look at this, look how consistent the outperformance has been. To me, that actually spells a better stock, and certainly one of the many factors we can look at as we adjust portfolios. Here's a couple stocks on my radar. These are both from the InSync universe, and you can see these are weekly charts, and these are weekly charts here that have pulled back over the course of the last month and a half. So even as the market has been going up over the course of the last month and a half, these have pulled back, and again, I think are worthy of mention. We'll finish off with Sector Watch and we'll be done for the week. Gold stocks up on the top of the list. They continue to do well. They are volatile, but they do continue to perform quite well. And you can see again, there's REITs down on the bottom and so forth. But we got mostly green in this table, which means most stocks and most sectors and most risk assets are rising. And again, that's where we're at. So please follow me on X. I'm at David Cox RJ. Thanks again for your time this week. This has been David Cox, Portfolio Manager at Financial InSync in Waterloo, Canada.